And welcome to Power Breakfast. I'm Pavitra Parekh. Those are all of the top headlines that we're tracking for you this morning. As always, let's kickstart the show by taking you what's happening across global markets, because we did once again get quite a weak handover from Wall Street. And on the back of that, you have all of the Asian markets which are trading with deep cuts. So you have the Taiwanese index, which is up on your screen. That is the biggest loser this morning, down over 3.5%. Nikkei, the Korean markets, both of those also seeing cuts of over 2%. So it's looking like quite a weak opening across Asia. Hang Seng is up on your screen. That one is down around 150 points, so around 0.9% gone for the Hong Kong market as well. Shanghai is seeing just some minor losses at the start, so it's faring relatively better. It's around 0.2% in the red, and the only Asian market on my screen which is managing to sort of hold in the green is the Straits. No big gains, of course, but it's around 0.4% higher on the Straits index. So that's what's happening across the Asian markets. The SGX Nifty is also up on your screen, and it's quite flat right now, just around 24 points lower is what we have for ourselves on the SGX Nifty. So let's see how we move from here. We're definitely looking a lot better compared to the kind of handover that we've got from global markets. But let's also talk about the US now. Wall Street ended yesterday's trading session sharply lower. The rates are up on your screen. So the Dow Jones closed the day with a cut of nearly 100 points. The S&P 500 was 0.8% lower, and the Nasdaq meanwhile closed the session at a 2-year low, and it was down over 1% in the trading session. In fact, Wall Street also digested some key comments which came in from JP Morgan Chase CEO Jamie Dimon. He spoke on the US heading into a recession, the impact of the Russian invasion of Ukraine on markets, as well as the Fed's inflation fight. So let's listen into some interesting excerpts from his conversation with CNBC.
What about stock markets? Where do you see the trough for the S&P 500?
Oh, I don't know. Look, it may have a ways to go. I mean, it really depends on that soft landing, hard landing thing. And since I don't know the answer to that, it's hard for me to answer that. But it could be another easy 20%. And I think like the next 20% will be much more painful than the first. Rates going up another 100 basis points are a lot more painful than the first 100 because people aren't used to it. And and I think negative rates, when all is said and done, will have been a complete failure. You got to put two things in mind here. Currently, right now, the U.S. economy is actually still doing well. Consumers have money, fiscal stimulus. They still have more than they had before. They're spending 10% more than last year, 35% more than pre-COVID. Their balance sheets are in great shape. Yes, debt's gone up a little bit, but not nearly to pre-COVID levels. And therefore, even if we go into recession, they're going to be in much better shape than 08 and 09. But you can't talk about the economy without talking about the stuff in the future. And this is serious stuff, okay? This is inflation, which obviously is, changing the effect of those numbers I just told you about. It's rates going up more than people expected already, and probably a little bit more from here. It's QT, which we've never had before. So therefore, the unknown effects, and you see it today in bond markets around the world and sovereign markets and people selling U.S. Treasury debt, and it's the war. And these are very, very serious things, which I think are likely to push the U.S. And the world. I mean, Europe is already in a recession, and they're likely to put U.S. in some kind of recession 6-9 months from now. In hindsight, they waited too long and did too little, and QT should have started sooner and all that. But they're clearly catching up. They're clearly motivated to catch up, and from here, let's all wish them success and keep our fingers crossed that they manage to slow down the economy enough that it doesn't, to cause it, whatever it is mild. This again is fairly typical. Markets go down for people forecast the economy, et cetera. The IPO market closes first. That's kind of happened. High yield closes second, and structured credit. That's kind of happened for the most part. Things can get done, and then it starts to affect other credit. You saw with the gilt markets here, you see a lack of liquidity in a lot of markets. A lot of intermediaries can't intermediate like we used to because of regulations. It is going to happen. And I think the likely place you're going to see more of a crack and maybe a little bit more of a panic is in credit markets. And it might be ETFs, it might be a country, it might be something you don't suspect. If you make a list of all the prior crises, sitting here, we would not have predicted where they came from, though I think you can predict it this time that it probably will happen.
All right, that is Jamie Dimon saying that he sees another 20% downside in terms of fall for the S&P 500, and saying that this could put the U.S. into a recession in the next 6 to 9 months. So that's some important opinion coming in. But with that, let's move on and bring you the final update on our global market wrap. European markets began the week marginally lower. So the French CAC index was down around 20 points at the close. The German DAX index ended quite flat, and the FTSE closed with cuts of around 30 points. Now, the Bank of England also announced further measures to ease liquidity volatility, the central bank said that it would ensure an orderly end to its bond purchase scheme on the 14th of October. In fact, the UK Finance Minister will also deliver his medium-term fiscal plan on October 31st, which is 3 weeks sooner than previously scheduled. So those are some important updates that we're tracking coming out of the European markets. But that's everything that's happening globally. Let's talk about everything you should track as we move into a fresh trading session. We have our research team joining in with the trade setup and all of the individual stocks also that you should keep on your radar. Vivek, Vahishta and Nigel join us now with exactly that. Guys, a very good morning to all of you. And Vivek, let me come across to you first. Take us through all of the market cues that we should track this morning.
Well, good morning. Well, it's quite a mixed cues that we've received as far as the global markets are concerned. In fact, quite weak. But when you're talking about the U.S. markets, gave a very weak close. In fact, the Nasdaq fell down over 1% yesterday, and it's actually closed at the lowest level in 2 years. Now, this particular decline was led by the semiconductor stocks. And as we heard, JP Morgan CEO Jamie Dimon say, they are preparing for a hard landing in terms of interest rate. Now, this has actually led to quite a significant sell-off across U.S. markets, and U.S. markets continued the fourth straight session as far as declines were concerned. European markets too followed suit. While the declines were not as significant as the U.S. markets, they all ended in the red. However, when you're talking about gold prices too fell quite significantly, almost a 2% downtick in yesterday's trading session. And when you're talking about crude oil prices yesterday gave a little bit of a breather. And when you're talking about Brent futures fell down over 2% yesterday in the session. Coming closer to Asia, remember yesterday we had a whole host of Asian markets that were shut for trading. Today, however, most of them are back. Japan as well as South Korea have resumed trading after yesterday's break, and both of these indices are indicating that Asian markets have not come off to a good start. Both of these particular indices have fallen down over 2% in the session today. When you're talking about Indian markets, remember, yesterday bounced off quite significantly off the lows, and today in the trading session, the entire IT pack will be in focus on the back of the strong results that came in from TCS and also the buyback announcement that INFI has done. SGX Nifty, however, is indicated a muted start as far as Indian markets are concerned. However, the decline that SGX Nifty is indicating is not in line with what Asian peers are indicating. So hopefully India can continue to outperform.
All right, let's wait and watch for that. For now, it's looking much better than what the rest of Asia is doing. Around 30 points lower is what we have on the SGX Nifty. Vivek, thanks a lot for that. Let me also bring Vahishta in. She has the list of entire stocks that you should watch out for in today's trading session. And Vahishta, of course, let's start off with TCS.
Yes, that's right, Pavitra. TCS is, of course, the big one in the pack. It reported a good quarter with a beat on revenues and on the margins. The US dollar revenues grew by 1.4% to $6,877 million, while the rupee revenue was up higher at 4.8% to 55,300 crores. Moving on to Infosys, when the company has said that they will consider a proposal for buyback of shares on the 13th of October. So some good news for both the IT players. Moving on to Jtl Infra, the consolidated revenue for Q2 of the ongoing financial year has grown by 14% year-on-year to 300 crores. For Panacea Biotech, the company has received a long-term supply order worth $127 million, which is approximately 1,000 crores from the UNICEF and Pan American Health Organization. For India Cement, the news is that the company has sold its entire shareholding in Springway Mining to JSW Cement. For Adani Ports, the company has received an NCLT approval for the acquisition of the Gangavaram port. And the last one on my radar is Inox Wind, wherein its subsidiary Inox Green Energy Services has sold the entire equity shareholding which was held in Wind 1 Renergy, Wind 3 Renergy and Wind 5 Renergy to Adani Green Energy. Back to you.
All right, Vaishya, thanks a lot for that entire list of stocks. We're going to watch out for all of these in today's trading session. And finally, let's bring in Nigel, who's looking at all of the cues from the futures and options space. Hi, Nigel.
Well, morning, Pavitra. First up on the institutional flows, the FIs, they continue to sell, but the DIs, they put in larger amount of money. Keep in mind, the FI participation yesterday was relatively lower. Now, the live indicator we have is the premium or the discount on the Nifty futures. And yesterday, it moved into a discount, telling you that there was some short positioning. And that perfectly, ties in because on the Nifty open interest, there was a big surge. You have close to around 8% in terms of open interest build up. So that told you that there was some kind of build up on the short side on the Nifty. While on the Nifty bank, it appears some of those shorts, they were covering some positions in trade yesterday. What does the FIs do though in the FNO market? Well, they added shorts. Close to 14,000 short contracts is what they added, and the short positioning goes to around 82% odd. On the index option side, you're not getting any big direction. They're writing, they're buying puts as well as calls, so that was pretty much even Stevens. Two strikes we're looking at. 17,200 call, that was very active yesterday. The premium was around 150 rupees. Telling you the first resistance comes in at around the 17,350. On the downside, the 17,000 put was very active. The premium out there is around 50 rupees. So 16,950, that becomes the first level of support. The broad range, though, will be 16,950 to around 17,500, which perfectly ties in 20 and 50 DMA, resistance zone out there. While on the downside, you have the 200 DMA, that's a bit of a support zone. The Nifty Bank, that's the star, that's the joker in the pack. Last couple of sessions, they've come off the day's low. And also, on a closing basis, the closure around that 50 DMA. You'd like it to cross that level and then make a bit of a dart to around 20 DMA. So IT will support to start, but Nifty Bank needs to do what it's been doing in the last few days. For the last few days, you're buying the dip, so you enter when the Nifty is around 100, 150 points odd. It's been working, so I guess the bulls will try that yet again. For starters, good to see that the SGX Nifty is indicating a pullback. So maybe you get a deeper downtick, then in fact, that could possibly get bought into. Back to you.
All right, Nigel, Vivek, as well as Vahishta, thank you all very much for joining us and taking us through the trade setup this morning. With that, it's time for our first. Welcome back. You're still tuned into Power Breakfast, and let's talk about the earnings season now, which is definitely off to a good start with IT major TCS posting a good set of Q2 results. In fact, the company posted a beat on the revenue as well as on the margin front. So Rima is here to break down all of the numbers for us. Rima.
Thanks so much for that. TCS Q2 surpassing expectations in both revenues, margins, constant currency revenue growth at 4%, EBIT margins at 24%, expanding by 90 basis points, again higher than street expectations. The company's won orders worth $8.1 billion in the quarter gone by, similar to what they had in the last quarter. So that's a positive, because the street was worried that with the challenging macros that we're currently in, the deal wins could show an impact. That's not been the case this time. In fact, the two troubled verticals, Europe as well as UK, have shown close to about a 15% year-on-year revenue growth. The only worrying point has been the hiring numbers. Hiring for TCS is sub 10,000. This is a big drop-off compared to the hiring numbers that they had in the prior quarters. Why is that? That's point number one. And secondly, attrition has gone up even further, 21.5%, but the management is fairly confident that attrition has peaked out. In a nutshell, TCS has delivered and beaten street expectations on both revenues as well as margins. So at least for now, this should allay street concerns.
All right, should allay street concerns. Rima, thanks a lot for taking us through all of those numbers. But on that note now, let's also listen into what TCS MD and CEO Rajesh Gopinathan, as well as COO and ED N Ganpati Subramaniam had to say on the macros, the demand environment, and what the deal pipeline is looking like as well.
There is an increasing sense of caution that is in the discussions that we sense. But we had told you last time that it is not yet materialized into our order pipeline, and that continues to be the case now also. So there is that increasing sense of caution. There is that increasing sense that we need to be wary of uncertainties. However, I believe there is space if we are staying close to find opportunities for growth. But will we be totally insulated? Very difficult to say.
The demand environment, as Rajesh mentioned, is quite good and across geographies and as well as vertical segments. But there are some softnesses that it is to be expected. That especially when it comes to the question of long-term deals, long-term decision making, it's only natural to expect certain amount of softness given the overall macro environment. And Europe, much of the focus is right now on, looking at how this winter is going to be.
All right, that is the management of TCS. And remember, you can catch the TCS top team live today on Bazaar at 8:25 a.m. So stay tuned for that interesting conversation. Okay, with that, we're going to get into a short break now. But on the other side, we're going to shift focus from equities. Welcome back. You're still tuned into Power Breakfast on CNBC-TV18. And as always, let's get Manisha in to bring us what's happening in the world of commodities. Manisha, good morning. What are you looking at today?
Well, I'm looking at the industrial commodities where we have seen another day of decline, and that is because the US dollar index seems to have gained for a fourth straight day. So we did see crude oil prices decline 2% overnight. So the prices have eased from the 6-week highs that we started this week on. There are worries about global demand growth, but the markets will also look at the fact that the Saudi Arabia is saying that it will serve all its Asian customers to full contract volume. So even as we have seen output cuts, Asian consumers will really not suffer because of that. Metal prices, in the meanwhile, have seen some strength today as well. You have steel trading at a one-month highs. That is because China has come back from its holidays, and we've seen some restocking from there. Copper is gaining because of the Chile closing a mining stop in north part of the Chile. Zinc is also trading firm after Glencore has curtailed production at a Nordenham plant in Germany. So it is about supply concerns, which seems to be supporting metal prices yet again today.
All right, Manisha, thanks a lot for getting us that update from the world of commodities. But with that, let's also bring you the latest developments on the war in Ukraine. The leaders of the G7 group will hold an emergency meeting today following coordinated Russian missile strikes on civilian targets in cities across Ukraine, which killed at least 14 people and injured almost 100. The Ukrainian President Volodymyr Zelensky is also expected to speak at the meeting. Top officials in the United States, European Union, as well as at the United Nations have expressed shock and horror over the strikes. U.S. President Joe Biden said the assault once again demonstrated the utter brutality of Russian President Vladimir Putin's war in Ukraine. Russia's missile strike, remember, comes just 2 days after a blast on the Crimean Bridge, which significantly hurt its war efforts in Ukraine. So that's an important update that we're tracking for you, the G7 meeting, and we will bring you updates from that as well. With that, we're out of time on this edition of Power Breakfast. All of the Asian markets are sharply lower. You have the Taiwan trading with a cut of 3.5%. Nikkei, Kospi both down around 2% right now, but the SGX Nifty is seeing a cut of just around 40 points. Thanks a lot for tuning in. Bazaar Morning Call is up next.